Well, there's a look at what's been happening over the last month of trading, and there are two takeaways from looking at what's happened on the TSX and the S&P. Number one is that it has been a fairly choppy stretch, to say the least, as evidenced by both of those charts. But under the hood, there have been more signs of a rotation, and that is something that, at the very least, has allowed the TSX to marginally outperform the S&P 500. Let's talk about more on the market dynamics from David Burrows, President and Chief Investment Strategist at Barometer Capital Management. David, good to see you.
Great to see you.
Okay, we've talked a lot about volatility. I think our regular guests have sort of a sense on what's been going on there. But when you look at sector activity, what stands out to you?
Yeah, look, I think we are in a pretty healthy market. I mean, there's lots of things to worry about. But if you looked at the S&P in June, only 24% of companies were beating the index. It was a very narrow market, and tech had a huge impact on that, partly because they had all the earnings for the first half of the year. But if you look at what's happened since then, actually in the last 30 days, 63% of stocks are ahead of the index. Now, why is that interesting? Well, the big sectors that have been performing better than the market are financials and industrials, some areas of energy. Well, those are big sectors in the Canadian market. Whereas on the other side, you had semiconductors sell off 30%. They've only regained about a third of what they gave up. That tells you there's not huge demand. And on the other side, financials sold off 4% and are back at highs. So there's money moving in this market. There's money moving to smaller market caps. There's money moving towards sectors that are less owned. And part of that is because if you took earnings over the last 5 quarters, outside of tech, there was no earnings growth. And this quarter, where earnings were up 9%, you got the first positive contribution from the rest of the market. So the market's looking ahead to the next business cycle. And a lot of companies are becoming more efficient. This quarter was a record number of mentions of operational efficiencies. And that's having a positive impact on a lot of companies where their earnings are now starting to grow. And next year, we probably have low teens earnings growth. And that's positive for some of these sectors we're talking about.
So maybe on the one hand, companies might not be set to do a lot of hiring, but if they can be more efficient with the teams that they have, maybe they don't have to make tough decisions and have firing, and then kind of gets you back to sort of that nice ideal scenario that people are hoping for. Inflation improves, rates come down, all that kind of stuff.
That's exactly right. We're not seeing tons of revenue growth right off the bat, but we are seeing estimates for profit margins continue to grow. And that's important because we have to sometimes disconnect what the market's doing versus demand in the economy, because it's not the only thing that drives returns.
And what about just the interest rate trend? Let's assume that the Fed kicks off their rate cutting cycle in September and there's some steady movement towards lower rates. We're already seeing that here in Canada. How do you think that's ultimate, just that phenomenon impacts how people think about things like, short-term GICs or fixed income products that might all of a sudden, the dynamics change? And maybe there's like dividend stocks that start to catch a bit or something like that.
Yeah, so certainly when rates start to fall, that's liquidity going into the market. And it means companies that, have debt, maybe they can get a lower cost on their capital. That's a positive thing. So that's good for small and mid-sized companies that tend to have a little bit more debt. It's good for defensive stocks that have a high dividend yield. They become more attractive. We've seen utilities and we've seen real estate investment trusts do a little bit better. That's a positive. It's also, yes, it's good for bonds, but actually it's been even better for dividend growth stocks. Since October, when rates hit their peak, the bond market is up 7-8%. The dividend growth cohort of stocks is up 24%. So lower rates are good for a lot of different types of businesses. They're also good for, say, biotech stocks, where their earnings are way off in the future. And when you have a lower interest rate, you have a lower discount rate, discounting those future earnings back to the present, which means they can trade a little better, and they are.
Okay.
So a lot of things that are benefiting.
You're always good about putting some pick ideas on the table to kind of build out the thesis. You had a few here this morning that you're willing to share with us, but I feel like you've already touched on a couple of themes. You talked about utilities. There's a company here, Southern, which is on your list. You talked about biotech. There's a company, Regeneron, which is on your list, which has had a nice move this year. And then others like Waste Connections, Agnico Eagle in the gold sector, Element Fleet Management. I'm not sure there's a common theme for all of that, but those are definitely not tech stocks.
No, I mean, these are all companies that are executing well. They're all companies that were doing well before their sectors started to do better. One of the most important things you want to look at when a sector starts to perform better, what is it that was already doing well while it was out of favor? They will tend to continue to lead as the sector comes into favor. We like to call them good getting better. We want them good to begin with. We aren't looking for turnarounds, but then when they get a tailwind, people say, they look back at the group, they say, hey, these guys at Regeneron have a whole bunch of new drugs in the pipeline. They're doing really well with what they have right now. We didn't need this tailwind, but the tailwind certainly will help bring more investors into the sector and notice this stock.
One of the big themes what we've been watching this morning outside of the broader story of stocks, before the break, for example, we were comparing the TSX to the S&P, is the comparison stories within retail. So on the one hand, you have Target shares. They're surging today. They're up more than 14%. Bailey Lipschultz of Bloomberg was telling us that they seem to be finding their groove with lower prices. They had struggled for several quarters on the sales front. Then you've got Macy's, which when it comes to competition on price, really seems to be struggling these days. Those shares are down 13% at this hour. We're back now with David Burrows, President and Chief Investment Strategist, Barometer Capital Management. Does it surprise you to see a tale of two retail stocks this morning?
No, it's actually very interesting. You know, consumer discretionary has been a tough sector all year long, falling relative strength versus the market, which means a lot of stocks have underperformed, like Nike is a great example. And really it's come down to want to haves versus need to haves. So companies like Costco and Walmart, they've been stars all year long because people are going there, they're cost conscious. Target historically has played in the middle. However, they sell a lot of discretionary goods. Macy's, on the other hand, you know, has really had a tough time. If you look at next year, Macy's just guided lower, and they already were expected to have lower earnings next year. Target had a small upgrade to demand. They said their same store traffic is up about 3%, which people expected to be 1%. The revenues are going to be a little bit better. So that's a shift taking place. That's positive. Frankly, I'd prefer to stay with Costco and Walmart. You know, Costco is going to have 20% earnings growth next year. They really didn't have any slowdown through the course of this year. But this is really a sector you have to pick your spots. Travel and leisure has been poor. High-end retail has been poor. You need to find the sweet spot where you're seeing improvement. And Target arguably are operationally getting better.
And, you know, when I look at the Canadian retail landscape, just feeding into that, the overall Canadian stock market is up this year. I think Dollarama shares are up 4 times the broader market. And I know the dollar store business isn't the easiest thing. Just look at the American players on that front. But the thesis around Dollarama seems to play into what you were talking about, closer to a Target in that sense.
Well, yeah, but operationally they are dynamite. This is one of our top 10 holdings, Dollarama. We also have a big holding in Loblaws. Both companies have done really well in this environment, again, in a tricky consumer discretionary environment.
And then I guess when you think about this group going forward, like we were talking about, interest rates come down at some point, maybe we avoid a worst case economic picture. Is there room to potentially see more interest in these stocks longer term? Or I guess, is it still that good getting better or good staying stronger thesis that plays into this sector?
I would prefer to own a company where they already are doing well, because if you try to buy turnaround situations, you might get it right, or you may really get it wrong. And so until there's evidence of a shift, you know, when you have a company like Amazon saying they're finding it difficult in their core business, that tells you something about consumer demand. And I think that, you know, we're going to get the revisions to the employment numbers today at 10 o'clock.
Yeah.
And potentially, there could be a significant downward revision in the number of jobs that have been created over the course of the year. That's going to be an important number to watch and important to see how the market reacts to that, especially around these discretionary stocks.
And then later this week, we're going to get some retail sales data for Canada. I think it's pretty much baked into the cake right now, unless there's really some other storyline that emerges that the Bank of Canada is going to cut interest rates for a third consecutive meeting come early next month. How do you feel about the health of the retail economy in Canada at this stage of the game?
For us, I think we have a total of 4% of our assets in consumer stocks. Consumers have a lot of debt. On the other side, industrial companies have very little debt and are benefiting from a lot of tailwinds of reshoring of manufacturing, so you pick your spots. Now, you know, the market's looking ahead to the next business cycle. We'll start to see data and see if it starts to get better, but I will be show me on these before we're going to put more money to work.